Well, at this point, it does look like they're headed towards another 25 basis points. It probably in May, but sometime in the second quarter. Um, However, obviously they'll be very cautious about their guidance going forward because they're still inspecting all the data, and the effect of the banking crisis is still yet to really be quantified. But for the time being, I think they are looking to continue hike rates. The oil price hike also would lead to that sort of conclusion. However, there was virtually no follow-on from other commodity prices from the rising oil prices. I mean, logically, they would sort of react, I mean, because oil is a feedstock, but grains were not strong, copper was down. There's very little inflationary mindset out there due to this crude oil price increase.
Why do you think that is, John?
Well, I mean, obviously the ISM helped the data, the price action last night against inflation. There was a very weak print on ISM, and that automatically put the hammer on a lot of commodity prices, in particular copper, and bond yields also fell dramatically on that. So yes, there's hope that inflation will continue to be suppressed by lower activity, and we basically agree with that. We think there's going to be continued problems in the financial sector, not necessarily bank runs, but lots of sort of minefields ahead for shadow banking, in particular with an emphasis on commercial real estate, which is a huge asset class, in particular in the States and in Europe. So we have GDP below consensus, and for the next couple quarters in the 0 to 1% range.
All right, so it sounds familiar. You're not the only one saying stuff like this, John. So why do you prefer the U.S. market then over the next 2 quarters?
Well, there's something about the way the U.S. Corporate sector can keep hiking earnings almost no matter what. There was a very large upward revision in an industrial company overnight, which was shockingly good. There's just a very strong ability for U.S. companies to raise profits. And the first quarter numbers will be down year on year, but they probably will surprise on the upside, so it seems. We'll have to see with the banks and their provisions and whatnot. But it doesn't seem like the earnings picture is as bad as people had expected, and lower bond yields will definitely help the stock market, at least in the short term.